In this video, we're going to take a look at what happens when a company declares and then issues dividends. Now, just to define what a dividend is first, in case you're not familiar with the terminology, a dividend is basically a payment to an individual shareholder. So a public company has many shares outstanding, a lot of stock outstanding, and let's say they decide at some point that each share is going to receive $1. So they issue a dividend of $1 per share dividend issued. So what this means is that if you own 10 shares of the company, you will receive $10, 10 times 1 in that case. If it's a much larger shareholder and they own 500,000 shares, then they would receive $500,000. So that's basically how dividends work. And the reason I want to address them in some detail here is because actually issuing dividends is fairly simple accounting-wise, but the actual process of declaring them and then issuing them is a little tricky, and the accounting for it you may not have seen before. So I want to go over how it works and then show you how to answer questions on this in interviews. So to start with, I'm just going to go over here to dividends declared and dividends issued, and these are going to be the two lines that we work with in this case. So we're going to start by first declaring a dividend. What this means is that the board of directors of a company or the management team of a company says that on June 30th or December 31st, we're going to pay each shareholder 50 cents per share. Now, they've not actually paid it out in cash yet. They've just said that they're actually going to pay the shareholders X amount per share on a certain date. That's what declaring a dividend means. So I'm going to enter in 100 here for dividends declared. So with this entered, now I'm just going to walk through the three statements and show you exactly how everything's impacted in this case. So first off, note that there are no changes on the income statement. And the reason this happens is because dividends are not considered a standard business expense for a company, part of its operations. When you pay out dividends, it's not like you're paying for inventory or paying for employees. You don't actually have to pay out dividends if you don't want to. So it's not really part of your business. It's more just sort of a reward for shareholders, for equity investors in your company. Note that dividends and earnings per share here have no relationship. The amount of dividends you pay has nothing to do with earnings per share. Now, they're both per share numbers, but that's all they have in common. The earnings per share is really just a paper value, a book value based on net income divided by shares outstanding. Dividends issued, this may be lower than earnings per share, it could be higher than earnings per share, or it could even be zero. So dividends issued and earnings per share have nothing to do with each other, so don't fall into the trap of thinking that they're related somehow. So no changes to the income statement. Let's go over to the cash flow statement. On here, nothing has changed under cash flow from operations or cash flow from investing because dividends are not considered part of a company's operational or investing activities. And then, contrary to what you might expect, even on the financing side, there are no changes for just declaring dividends. So we do have this dividends issued line, but remember, we've only declared the dividends at this point. We have not actually paid them out in cash. So our cash balance stays the same here. Now on the balance sheet, there are no changes on the asset side because we've not actually paid out any dividends in cash yet. On the liability side, what we have is this new line item getting created called dividends declared right here. And this is basically just a journal entry on our balance sheet telling us, reminding us that the company has declared dividends and has to issue them at some point in the future. Now, the counter entry for this one, what will appear under shareholders' equity is that retained earnings will go down by 100 in this case. The reason retained earnings goes down by 100 here is because the company is basically saying at some point in the future our retained earnings is going to decrease because we have to pay out these dividends. Now we haven't actually paid them out yet, but this dividends declared line item is telling us that we're going to have to pay them at some point in the future. So we're going to deduct them from our retained earnings balance right now. And so that's why retained earnings goes down to balance the dividends declared line item right here. Now I've listed dividends declared under long-term liabilities. You could also list it as a current liability. It depends on when you're going to pay it out. If it's within the span of a year, it would go under current liabilities. If it's going to be over a year, then it would go under long-term liabilities. So that's how dividends being declared impacts the three statements. Really the only effect is that on the balance sheet, dividends declared under liabilities goes up and retained earnings under shareholders' equity goes down. And so everything remains in balance like that. So that's the first step of this process. For the next step of this process, what I'm going to do is under dividends issued, I'm going to change this and enter in 100 right here. So now we've declared the dividends and we've also issued them. So as before, there are no changes on the income statement. So when you declare a dividend, the income statement doesn't change, and when you issue a dividend, the income statement also does not change at all. On the cash flow statement, no changes under cash flow from operations or investing because dividends are not an operational or investing activity. Under financing, now we have this line item for dividends issued. And we need this because dividends being paid out uses up some of the company's cash balance. So we need to have it under financing. Dividends being issued are going to be a net drain on our cash flow, so overall our cash balance here is down by 100. On the balance sheet, on the asset side, cash is down by 100 because we've issued the dividends, so overall assets are down by 100. And then on the liabilities and shareholders' equity side, dividends declared goes back to its zero number here because the dividends are no longer declared, they've actually now been issued. So what happens is under shareholders' equity, retained earnings is down by 100 to balance the fact that we've paid them out in cash now. So dividends that are paid out in cash, they come out of cash on the asset side and they come out of retained earnings on the liabilities and shareholders equity side, and that is how your balance sheet balances. So overall liabilities and shareholders equity is down by 100, our assets are also down by 100, and our balance sheet balances. One additional point I want to raise here is that when you're playing around with these numbers yourself, be careful with these two. Because what happens here, the way I've set it up, is that you have to declare dividends in this model before you actually issue them. If you just issue them, the problem is that retained earnings here is not going to change properly because we don't want to be double counting them. So I have not subtracted issued dividends from retained earnings here. I've only subtracted declared dividends because I've assumed that whenever you issue dividends, you're going to declare them first. That's just something to be aware of. If you want, you can modify the model so that it works properly. You can even get rid of this dividends declared line item if you want and just have dividends issued. But that's just something to be aware of. That's really the only thing that you need to be careful of when you're playing around with the numbers in this model and changing around some of them yourself. So I'll just delete these right now. So that's a quick overview of how declaring and issuing dividends works accounting-wise. Again, the important points are that nothing is ever impacted on the income statement. EPS is never impacted. On the cash flow statement, operations and investing are never impacted. It's only financing activities when the dividends are actually issued. And then on the liabilities and shareholders' equity side of the balance sheet, you could have this dividends declared line item that is counterbalanced by retained earnings here. And then, of course, when the dividends are actually issued, your cash goes down and your retained earning balance goes down. So that's a quick overview of how declaring and issuing dividends works, and that should guide you through any interview questions that you receive on this topic.